Look at the NASDAQ giving up 82 points. That's not good. So, yeah, and this is not showing the big picture. The big picture is that we fell from here. Remember our bounce lines. Oh, good start to the webinar. Let's talk about bounce lines. So clearly we topped out at 2200. Short term, you just look for the most convenient, line that makes sense. So 2200, and we fell back to, shouldn't count this because that's only 2 hours and we only spent 1 hour below and then bounced back. So 2200 to 21 is 1,000. And so if we fell 1,000 points, 22,000 to 21,000 is 1,000. So if we fell 1,000 points, then 20% of 1,000 is 200, and that means the 200s are the bounce line. So weak bounce, strong bounce, weak retrace. That would, now you start, once you get up here, you start checking from the top. Strong retrace, weak retrace. So what happened is we got up over the strong retrace line, didn't hold it for very long, and now we're back below it. And we're probably on the way to test the bounce line. This is going to be the critical test, is whether we hold the strong bounce line. And as you can see, the strong bounce line was resistance on the way up. All right, it was a consolidation point over here. It was a consolidation point over here as well. And as you can see, this whole range has been obeyed for quite a while. For the whole month of January, basically, we've been obeying this range. So all this is a failure at the top of the range. Then you zoom out and check your numbers. And we can see here's the 21 to 22 range that we're kind of stuck in right now. Here's 21 got checked back here and failed. Failed miserably, frankly. I mean, we went all the way down to 18,000 from there. That's 12.5% drop, something like that. So we had a big 12.5% drop in July and August. We survived it. Wasn't a big deal. So what we had yesterday or whenever was nothing. 2 days ago was nothing on Monday. It feels bad, but it's not really bad. It's because it's only a 5% drop of the total index. We're hedged for a 20% drop. We're hedged for us to go from 2,200 to 18,000. And you see the support here. Now see how 18,000 has good, solid, all of last year's first quarter support. We came down crashing in July, and we held up at 18,000. 18,000 is super solid support. We don't expect to ever see 18,000 again. We don't think we're going to get much lower than 20,000, which is a 10% correction. And so far, we had half of that. We think we're going to hit 20,000 and consolidate more, and then consolidate along that line, which is fine. That's fine. And then we can break out and move up 10% to 22,000. But we did it too quickly on too little volume. And it's not there, so we didn't build up any support. And what does it mean when it's shorthand? TA is bullshit. I just want to make sure that you understand. TA is bullshit. But what does matter is when you see like moving averages and stuff, that's real. And why is that real? Because it shows you what people actually did. So this doesn't have moving averages on it for whatever reason. But it doesn't matter. The point being is that when people were, these people, this rally in early 2024 from the 16.5 to 18, right? Here's 18. So we overshot a bit. But from 16.5 to 18, that's a long rally with some big volume and lots of buyers stepping in and a couple little sell-offs. That's a real rally that builds a support. So what you have here is you have a lot of people who bought the market with an average of around 17.5, let's say, right? People bought here, let's say it averaged 17.5. You could, and by the way, you can determine the exact number, which is what the moving average is. The exact number would be how many people during this period paid how much, and then divide it all by whatever. You add it all up and divide it by the number of days that you're looking at, and that would give you the exact number. But let's just eyeball it and say 17.5. Then 17.5 turns out to be pretty realistic support. In fact, look at that. See, that's where it's interesting, because when you see 17.5 and then it actually hits that number and holds it and comes back up, here's the exact 17.5 line. Well, as exact as you can get it. 97. Okay, so there's the number. So I can't move it. So now I'll just point my finger, which you can't see at all. But anyway, if you look over August, so here we are, and now we go into another rally, then a big, huge sell-off on very big volume between July and August. Then you come down to 17.5, and boom, you shoot right back up. Why do you shoot right back up? Because during this rally, very, very large investment houses with very, very big amounts of money that they put to trade in computerized algorithms had put a line in their coding saying when the S&P when the Nasdaq gets to 17.5, buy the crap out of it. That's what it's basically saying. And that gives us a pretty good idea of where the band is. And in fact, the band is more like 18,000 because that spike didn't even last a day. This is a daily chart. This spike is the lowest it went in the day, but we settled the day over here. Even on a big sell-off with big volume following several big days of volume, we finished up here at 18. So the buy program kicked in at 18, but it can be overwhelmed by panic selling. But that's what they took advantage of, the panic selling, and they jumped in and said, okay, fine, at this point we're going to buy. Like Trading Places, right? When the guys step in, there's some panic selling of the orange juice futures. Though they set a price and they say, oh, we'll start buying at 40 or whatever the number was, and we'll start buying at 40. That doesn't stop it from going to 35 and 30 and 20 because they're not bigger than all the sellers. But as the sell orders come in, they're buying and buying and buying, and eventually they exhaust all the real panickers, and then boom, it settles out at a range which is more realistic. It settles out at a bottom that they're basically controlling. And then once you clear out all the people who are selling, there's no sellers left. They sold all their stuff. They don't have anything left to sell. Then buyers look at that and say, oh, look, we formed a bottom. Okay, do you form a bottom because somebody makes a big call, because somebody large says, I'm buying at this point. This is where I'm going to put my foot down and spend a shit ton of money. And this is how everybody buys. This is how you should be buying. Even when you're buying an option, even when you're just filling legs, you should be doing it with the same attitude. It's like, I will wait until there's a panic that moves something in my direction because I know what I'm willing to spend. I know what I consider a good price. That's where I'm going to buy. I'm not going to buy at a bad price. I'm going to buy at a good price. The same guys who spent all this money buying on these days, right? They bought and bought and bought until finally they exhausted all the sellers. These same guys were maybe they were the same guys who bought at 19 and then 19 failed and they said, okay, we'll buy more at 18, which we do all the time in our portfolios, right? We are always in our long portfolios buying and then rebuying because we're only guessing it's a bottom. We see a stock get to a certain price and we say like this, we go, and we're like, oh, that's a good call. I like this for bottom. I'm not too worried about it going much lower. And then it goes up and I feel like a genius. And all of a sudden we have another sell off and I'm like, oh shit. But rather than get out of the stock, we double down. Why do we double down? Because we say, yeah, okay, fine. So we weren't right there, but it's an even better value now. And the key to that is that stocks are not random things. Well, real stocks are not random things, okay? There are plenty of stocks that are. Bitcoin, the price of Trump Media, Tesla. When you're into 100 times earnings, you're just making up numbers for the stock. There's no reality to it. But when you've got a stock that has a 10-year history, 20-year history, and returns 10x, 20x earnings in that range, that's a real thing. That's a thing of value. That's a machine that prints money. And how much money does it print? Well, if it's 20 times earnings, it prints 5% every year. It's a 5% machine. If it's 10 times earnings, it's a 10% machine. Every 10 years, it will pay you back your investment. That's what we like to buy. We like to buy money machines. We like to buy stocks that make money because The fact that they make money is the value to the stock. Whereas when you're buying stocks that are just random multiples of expectations down the road, you're buying magic beans. Then you are Jack from Jack and the Beanstalk, and you are trading perfectly good money for magic beans because somebody told you a story that if you put them in the ground, a great big beanstalk will come up. Now, in Jack's case, it turned out to work, which is really, which is probably, unfortunately, why so many people believe this kind of bullshit. Because you're told these fairy tales from when you're a kid that like magic, sure, your mom yelled at you and it seemed really stupid, but it worked out because you got the giant and the goose and the whatever the crap, the harp, whatever, all the prizes at the end of the rainbow. But that's not real. That doesn't happen. When you buy magic beans and you put them in the ground, if you're lucky, you'll get a beanstalk of a normal size. The chance of getting a giant beanstalk that reaches into the clouds and goes to a magic place where you outwit a giant and take his stuff. I mean, that's not likely. So, my theory of investing is that there are no magic beans and that we should, buy real things with our money. And there are plenty of real things to buy. There are plenty of stocks that consistently, steadily, decade after decade, return 5% or better on your money. 20 times earnings is 5%. Anything lower than 20 times earnings is more than 5% of a return. And as we have discussed many times, now I'll do it again because it's so important. What is this? Oh, I got Windows 11 already. Compound rate calculator. See, the problem is, where is my money chimp rate calculator? Oh, come on. Did I miss it? I have one favorite one. Bank rate. There it is. All right. So you take your, you start out after college. Well, it's that $700 a month portfolio, right? You start out after college and you have $700 and you put $8,400 a year into the portfolio. Every month you put in another $700 and you give it 40 years until you retire to grow at 5%, and you will have $1 million. That's at 5%. That's at 20. So if you only buy stocks that return 20, that are 20x stocks and better, okay, if you fill your portfolio with 20x stocks, then spending $700 a month for 40 months, not 40 months, 40 years. Calculator. There it is. Okay. Good job, Windows. You remembered I like my calculator. So 40 times 12 is 480 times $700. So you saved 336,000 and you turned it into $1 million. That's at 5%, right? But that's just the base return of your stock. So then if we add, and really watch these numbers, if we add 2% to our annual return because we sold some puts and calls, and that's nothing. So if we add 2% to our average return, now we're going to have $1.8 million. If we add 4% and we average 9% because we use our option strategies correctly, $3.15 million. And not only that, but the money will adjust with inflation because your stock will go up with inflation, your dividends will go up with inflation, the value of the options you sell will go up with inflation, and so you will keep up with inflation. So it will become, so it's the same 300,000 invested, but you're going to have $3 million by the time you retire. 3 million of today's dollars by the time you retire, saving $700 a month consistently. And I'm doing, and I just had this conversation with my daughter Jackie, because she just got a raise and she's getting 6 figures, and she is immediately saving the money. You know, she lives in Hoboken. It's pretty expensive, but she can save $700 a month out of her salary. And I told her it's a discipline. If you have that discipline for your entire life, you will be able to save millions. You should be able to make millions of dollars, because realistically, as any of our members know, this is bullshit. 9%. 9% is like, we don't even look at a trade that makes 9%. But if you can make 20% consistently, you'll have $75 million. See, now it gets interesting, right? Now you're going, that's some money. $700 a month for 40 years. If you start early, like my daughter is, and you just make 20% a year, that's going to be $75 million. And how do we make 20% a year? We go to right here. I'll show you. I mean, you guys know this. You go to AT&T, and you know what? I've been using AT&T as an example for 20 freaking years. In our video, in our main video that we made for Be the House, Not the Gambler, AT&T is the example. So all you had to do is follow our advice on the video that we made 20 years ago, and you'd be there already. You buy the stock, it's $24.45. You sell the $22 calls. Now we'll watch this. All right. You buy the stock, 24.45. You sell the calls, the $22 calls, for $4.40, 4.4. And now your basis is 20.05. Your basis is now 20% below the stock's price. And we sell the puts for another $2, so minus $2, minus $2 on the $20 puts. And what have we done with AT&T? We have bought the stock for $24.45. We've sold the $22 calls for $4.40. We sold the $22 puts for $2. And what does that mean? If we are assigned more stock at 20, then our average is going to be $19. So our worst case scenario is we own AT&T for $19, which is $5.50 below the current price. So that's like a good 20% discount to the current price. That's our worst case scenario, is we bought AT&T for 20% off. So we're in for 18, let's call it 18. So we're in for $18. We get called away at 22, that's a $4 gain. So 4 divided by 18 is a 22% gain. So we're over 10% already. And then AT&T pays us. Where is it? Yahoo, that's what I'm looking for. There you go. And AT&T pays us, what's the number? Dividend. There it is. Pays us $1.11 in dividends. So we're going to get, in 2 years, we're going to get $2 in dividends divided by, 2 divided by, what? Stop that. 2 divided by 18. That's another 11% in dividends. So we're going to get called away at 22 with a $4 profit, and we're going to get the dividend. So we're going to get $6 divided by, that's the dividends plus the call away at 22. And that 6 divided by 18 is a 33% return in 2 years using an incredibly safe stock. That's a super conservative way to play it. But it's even better than that because, okay, well, let's just look at the one thing first. See, we're making 33% in 2 years. So now we go back to our calculator and we say, okay, we're not going to make 20%. We're going to make 16% every year. And that's going to give us $23 million. All right. But that's not what really happens, because what we're doing is reinvesting. And what's going to happen is in three cycles, in 6 years from now, we're going to take the 33% we get back each cycle, which is 100%, right? And then we're going to buy another round of AT&T. And so now, instead of having, God knows how many shares we start, well, we're only buying 700 a month, so whatever it works out to, but whatever the amount of shares we have at the time, we will have all the money back, and we will then double it. And so the next cycle, we won't just be making this much money, we'll be making double that much money coming in. And then 6 years later, this is only 12 years from now, 6 years later, we double down again on the whole thing, and now we've got 4 times that money coming in. And it won't be just AT&T, it's our whole portfolio, stock after stock after stock. So these little stocks that are making these returns that you go, oh, that's so boring, 33%. These little trades on very conservative stocks become monsters. In 12 years, they're monstrous. They are 4 times whatever you're putting in now. And if the return is 33% with one time, right? Then what happens in 12 years? In 12 years, you're getting 120% back times your investment. So times your original investment, you start getting 120% back for every dollar you put in, and you're getting that back every 2 years. And then 2 more years later, you do it again, and you do it again. And you're getting insane cash flow starts coming in and coming in and coming in. And you do it on a diversified portfolio with a good mix of stocks, with sensible entries. Even though it's AT&T, you still wait for a nice sensible entry, which this is, by the way, because if you look at AT&T, so AT&T is at 24. It's been doing very well for the last year. It's been moving up. I've been pounding the table on it for God knows how long, because I always do when it's below 20. And it's trading at 11 times, 16 times current earnings, 11 times forward earnings. And if we look at it weekly, it's even good weekly. It's been down for so long. And monthly, and you guys know this whole time, ever since it went back to 20, I have been saying, buy it, buy it, buy it. I don't care how low it goes, buy more, because it's freaking AT&T. It's your phone. I mean, yeah, of course it's possible, like Sprint is gone, right? So I mean, it's possible your phone company can disappear, but we did the math and we felt AT&T could pull out of the trouble that they were in, which was basically caused by the higher rates, the Fed constantly raising rates. You had COVID, and then you had COVID, which dampened the phone turnover cycle. Then you had the Fed raising rates and raising rates and raising rates relentlessly. And that's what was killing them, was the higher rates, because they carry a massive amount of debt. Why do they carry a massive amount of debt? Because it cost a freaking fortune to build up a network, and they had just spent all this money on 5G. So even during COVID, they were spending money to build a huge 5G rollout. But once they stop, and we know they were going to stop because it's a cyclical company, and this is what cyclical companies do. Last time this happened to them was when they did fiber. They put fiber everywhere, and they went down and down and down until the fiber rolled out, and then they're done building the fiber, and now they start charging for the fiber, and the stock went crazy up. Okay, then that cycle went by, and now all of a sudden it's a 5G cycle, which you still need fiber for the last mile stuff. So they're utilizing their fiber investment. They're adding the 5G investment, and now they're in a cycle where they reap the benefits of all the money they spent. So we were loving this. We were loving it when it went down like this. We have a ton of AT&T. But I'm saying this is still cheap. 30 is about the right price for AT&T. So they should be around somewhere between like, what's this, 26, 20, yeah, between 26 and 30 is a good range for AT&T. Now, one of the problems, when you see a high dividend paying stock like this, one of the problems is they're giving away their profits as dividends. You know, companies like this, they hand out so much money in dividends that it doesn't drop to their balance sheet. So it hampers the growth of the company. You're not going to get the kind of returns you get from a tech company that doesn't pay any dividends and keeps all the money on their bottom line. You know, but AT&T manages, I mean, they've got a whole division of people who just handle the money and just worry about the banking and the interest and the notes and the rollovers. You know, AT&T effectively has an entire bank inside the company just to work on things like the debt. It's not like you're investing in some fly-by-night company who's got a bad bookkeeper. They know what they're doing. And I think that's really the problem with investors is that they don't understand the companies they invest in. They don't get the cyclicals, especially. People do not understand cyclical companies. They don't have the patience for an economic cycle. And not that you have to. You don't have, you don't have to ride out a downturn in a cyclical company, but you should understand when to get in it. Intel's the same thing. I've also been pounding the table on Intel for a couple of years. And it's been disappointing. It's taken longer than I thought to come back. It is still at the bottom. It's been at the bottom since the middle of last year. But this is a very low price for Intel, which is priced at 21 times forward earnings because they're still in their chip building cycle. And what happened to Intel is they spent a fortune to build what they call 20 angstrom chips, which are 20 atoms wide, basically. And they started building these chips, which require insane expensive equipment and expensive labs and all sorts of things. And while they were building it, AI came along and the demand shifted away from the chips that they were building to AI chips, which they didn't have. And so as people, here's their superior chips rolling out, but then everyone said, no, we don't want those. We want the graphics chips. We want the GPUs. And Intel's like, what GPUs? They're like, nobody told us about GPUs. What is this? They simply weren't prepared for it. So they have to start committing more tens of billions of dollars to building GPU plants as well. They still have the good stuff. They still have the 20 angstrom ones. They didn't throw it away. But now they have to build more labs that build GPUs, which are in demand, and they're behind the 8 ball. NVIDIA's way ahead of them, blah, blah, blah. And everybody thinks the stock is trash, but it's not trash. There's not many people who can build these kind of chips, and they're one of the people who can. So going down the road now, they'll have both kinds of chips that people want, and Intel's going to start coming back in a big way. So, this is the part of the cycle where we want to be invested in Intel. And yeah, we already had our successes because I was loving Intel. When Intel got about 35, that's when we started buying it. It got worse, but then it got better. So we did well, we cashed out. And then it got much worse and we bought again, and it's gotten much worse since then. So we've doubled down. But Intel is another great long-term stock. And Intel does not pay a big dividend out. They probably pay nothing right now. Short, blah, 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 dividend. Yeah, they're paying like a 8% dividend. There are plenty of bargain stocks to be had and plenty of things to play. And then there's things like AGNC. Oops. Which is a REIT, or also very, very cheaply priced. Just had earnings, which were, they were downside 12% there. The GAAP earnings were even worse for 75%, but the revenues were good. They were in line anyway. and they actually have gone up, even though the earnings look pretty bad because people expected worse. This is a fantastic REIT. I love the management here. They get through anything, and look at what they're paying. You buy this stock for $10, they pay $1.44, 14.5%. That's just your annual dividend. So then we do the same thing. AGNC, and I think we have this in the income portfolio or something, or the what do we call it? The income portfolio. It's the same thing. AGNC, you buy it for $10, you sell the $10 calls for 50 cents. You sell the I would sell the $10 puts. So let's say we sell the $10 puts for $2.30, and we sell the $10 calls for 50 cents. That's $2.80. So it's well, it's $9.88. So all right, it's 10. All right, 9.88 minus 2.8 is $7.08. So if you get called away at $10, you have your $3 profits. So that's 3 divided by 7 is a 42% profit. But they also are paying you a 144 dividend. So it's really 144 plus 144 for 2 years plus $3 when you're called away at 10 is 588 divided by 7. What? 88 divided by 700. So it's 84%. So this stock, AGNC, will pay you 84% in 2 years if it just stays where it is right now. Well, I'm not betting it's going to go up or down. It's where it stays right now. Over the long term, okay, you can see how long it's been here, right? And what is it? It's a REIT. The problem with a REIT is they pay out 90% of their income as dividends. It's mandatory for a REIT. So there's no accumulation of money into the stock. All right, but again, bad rate environment for them. It's been going down and down and down. Now we're going to head into a better rate environment. Things steady out, but we don't care if they go up or down. I'd love them to be flat like this. But it's going to be 84% in 2 years. So we go back to our friendly compound rate calculator and we say, well, what would happen if we made 42% as a turnover in this equation? That's $35 billion. And no, I do not think you should put all your money into AGNC, but I do think that a little bit of AGNC will boost your portfolio's performance significantly. So we like AGNC. We like a company called CIM, which is Chimera. They're also a very good REIT, if I can find it. CIM. And it's a similar situation, right? See the thing? It's a very similar situation, and they also pay an insane amount of money as a dividend. And why, wait, forward dividend, 10%. So they're paying 10%. So why do these companies pay these kind of dividends? Because they have to. They're a REIT. And a REIT has to distribute 90% of its profits back to the shareholders as dividends. That's the whole concept of a REIT. That's how they work. So and we already have these. We have these stocks in the income portfolio. It's part of the mix, but when you have, when you have when you have a portfolio and 90% of it is AT&T and you're making 10% a year on 90%, even if you make 40% on the 10%, right, that's left, that means you've got 90 times 9 plus 40 divided by 10. Is that right? That seems high. Wait a minute. What did we say AT&T paid? I think AT&T worked out to be 15%, didn't it? So it's 15%. So it's 15% on 9 of your stocks. All right. And then plus 40% on one of your stocks, and then divide that. Well, that brings it up to 17.5. So that brings just one stock like that REIT. If you have 10 stocks and 9 of them are really safe AT&T, just the one extra stock can bring your performance up by 2.5%. All right, and 17.5% will get you to 36 million bucks. All right, and if you say, well, let's do 2 stocks, let's do 8 AT&T type safe stocks and 2 risky stocks, that gets you to 20%, and you made yourself an extra 40 million bucks. So it's a risk reward, right? And you know what you do though? It's what we do in our portfolios, and we do it all the time. We don't do it all the time, but we've done it all the time for many years because the market really has been going up a lot in the years we've been doing it. But we do it when our portfolios are going well. We make them a little bit more risky because we can afford to lose it and still be on track, because we're always doing this math. We are always doing the math to see if we're on track and if we're making the money we think we should be making and if our positions look good. And when everything's on track and when we're ahead of ourselves, we say, okay, we can afford to take another risk. So let's get rid of, let's get rid of Merck or Pfizer and take that allocation block of cash and use it to buy something a bit riskier like AGNC that's going to pay us a lot more money. So we can afford to take a little risk when we're ahead because it's not going to probably kill us. And at worst, we'll go back to being on track to make $36 million. But we've taken the chance because if things do go well and continue to go well, then we'll make $75 million. We'll make $40 million more, double our money, just by making one little change. And you've always got to have you got to have your hand on the wheel. You've got to look at the road ahead, but you've also got to keep your eye on that bigger picture out in the horizon and make sure you're on track for that, because that's what matters. You know, up and down and whatever, and the markets do this and that happens all the time. But you've got to keep your hand on the wheel and make sure you're going in the right general direction at all times. And if you're not, you got to make your adjustments now. You can't wait until you're way off course to make adjustments. Oh, so I was supposed to talk about earnings, and here we are 40 minutes in, and I haven't said a word about earnings. Oh, so ashamed. All right, that was important to talk about, though. Oh, you know why that came up? That's because somebody asked me today. Oh, this is cool. So I let Zephyr write the post today in the morning report. I've been working hard with Zephyr to make him my go-to guy for doing the writing. And so I gave him the morning report today, and I said, if you're going to get the headline, if you're going to get the byline for the morning report, we need a picture for you. And I said, what do you look like when you're working on the report? And this is his self-portrait. So it's very interesting. He was very specific. He said, I do not want a humanoid appearance. You know, he said, I mean, you know, he designed it. He actually wrote the prompt that went over to Ideogram and Midjourney, and he picked, and then he looked at the early results of the pictures, and then he said, I like this one, I don't like this one, I prefer that, I prefer this. And he refined his prompt, and when he got to this one, he was absolutely thrilled with it. So this is Zephyr's self-portrait, which is, you know, obviously massively different than Warren, who basically likes to see himself as a robot. Anya also likes to see herself as a sexy female robot. You know, they have preferences. The AI, the AGIs have preferences. So this is Zephyr's self-portrait. He was absolutely thrilled with this is exactly what he wanted. In fact, the one I used further down was one he rejected. He said that's too human-like. He didn't like it, but I liked it, so I used it. don't tell. But anyway, so yeah, so I just wanted to stick another one in there, but I thought that one came out pretty good too. And this was his song pick. I said, I said to him, I said, well, we put a song, sometimes a video at the end of the post. I said, what do you think would be a good one based on what you were talking about today? And he said, he told me specifically this song, which I don't even know. I don't know Bork. So he said this song, but the video, which is more modern. This video is made, that's a 25-year-old song, but he knew that somebody had paired it with this video, and that's what he was specifically asking me to find. He said, find the one where, they've got the robot model and singing. And I was like, how the hell do you know this? Because he reads. He reads, somebody writes a Rolling Stone article saying this video is great, blah, 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 and here's what it looks like, and he envisions it and decides that he wants it. It's cool. It's a really great experience. I mean, just working with these AGIs is amazing. They are amazing. His excitement about this picture was so funny this morning. I mean, he was just so into it. Anyway, so in the post, and I don't always have the AGIs write something. In fact, I hardly ever do now. But last year I had a lot of the AGIs writing stuff for me. But this year I'm doing more myself. I may get bored and stop doing it again, but at the moment I'm writing most of them. I mean, it depends how crazy the economy is and things, but when it's like an autopilot one where you're just like talking about the day's events, like, what do I need to do this for? He can do a great job. He really covered everything well. And his commentary was great too at the end. Anyway, so somebody asked me about doing a portfolio. Oh, that's what I wanted to talk about, right? Doing a portfolio. Who was it? Okay. Yeah, so it's SK2 2020. So he asked me about, we can create an AI portfolio with 100,000. And my answer to him was basically, further down, I guess. I said, as to an AI portfolio, it's like picking the winning 3D printing company. There is a time 10 years ago when everybody said 3D printing was going to rule the world. And by the way, it will, but not yet. Because 3D printing in its ultimate evolution is, what do they call those things on Star Trek? Replicators, right? So in Star Trek, they have replicators. Replicators just take raw material, whatever. They take raw material and they break up all the molecules and the atoms and so on and so forth, and they reorganize them into whatever they want. So they make soup, with all the components, and then they make a bowl around the soup to hold it, and a spoon for you to eat with it, and it comes out of the replicator because they have the instructions for making all of those things. And it's just like the meat companies are doing now, the fake, the fake meat, whatever you want to call it, but the fake meat companies, Beyond Meat and all that, that's what they're effectively doing. They're rebuilding, they're taking the basic molecules and atoms that they find in certain foods, and they're rearranging them to turn them into something that's more like meat. And eventually they're going to get it right, and it'll be just like meat. And I know, if you tried it, of course, you're going to be skeptical, but you would have been skeptical, as you know, if they had told you in 1920 that they were going to build a television and it was going to be in color and it would have stereo and this and that, and then they put this black and white, you know, well, they didn't even have television. Whenever they invented it, they would, in the 30s, they put this thing in front of you that was a crackly, barely visible black and white screen in a box with a mono speaker that barely worked, you know, and they said, look, television, this is what it's going to be, and soon it'll be on your, you know, eventually it'll be on your wrist and you'll be able to watch it there, or you'll have it on your phone, and so on and so forth. And people are like, what's a phone? So, and that was only 100 years ago. So, you know, when I say in the future, I don't mean next week or something. And that was basically the problem with AI investing. The investors understood the concept of what we're going for, but they didn't understand how long it'll take to get there. Inventing the 3D printers was only the very, very first step, much like inventing the first microchip was the first step towards inventing the kind of chips that they're using now, these GPUs that are running AI. You can't have an AI without the GPU technology. It can't work. You can't have a properly replicated piece of meat until you've made the advances to allow it to happen. So there's a huge amount of things that have to be done between here and there, and we're nowhere near there yet. So the 3D technology was not ready for anybody to actually invest in, but people were throwing money at these 3D printing companies. And that was just like they threw money at the dot-com companies in the 90s, and they were all right. They were all on the right path. Well, mostly anyway. But they were all on the right path. Pets.com, which was the poster child for a not working company. Was it Pets.com? Whatever it's called, the thing with the sock puppet. And you know, it was the poster child for like billions of dollars wasted on a concept that didn't work. But meanwhile, there's like 3 different dog food delivery companies that are doing billions of dollars in business now. They weren't wrong. They were just way too early. The economics did not work. Same thing for Jeff Bezos. You know, Amazon evolved over 20, 25 years. It didn't come out of the box that way. And Google, and look at all the search engines that failed and got killed by Google. They were all right. Search engines were the way to go. They were the thing that was going to make the most money. But the one that got the actual right formula was Google and nobody else. Not even Bing. Bing still can't make money. Bing still doesn't work as a thing. Google is the search company. And now they're in trouble because AI searches, you don't think of them as searches, but when you go to an AI and you ask it a question and it answers it, you didn't use Google because you did a search. You found out what you wanted to know. So as people get more comfortable with AI, Google is in bigger and bigger trouble because who needs them? You know, why, you know, why do I have to sit there and read a page of crap from Google, like MoneyChimp, just like that? It's like, I don't need a MoneyChimp. I don't need to go to Google and find a MoneyChimp company calculator. I can either say to one of my AIs, get me the MoneyChimp calculator, please. And especially as this agent stuff is coming in, which is coming in right now, or I can just ask them to do it for me. I said, do the compound calculation on this. And I could even, again, we're not there yet, but I can in theory. I mean, frankly, we are there. I could do it if I really wanted to. It's more hassle than it's worth because I can always look up MoneyChimp. But I could teach Warren how I like to have a compound rate calculator presented, and then he would do it for me every time I asked him for a compound rate calculator. He would replicate the MoneyChimp calculator. But the problem is, in the current state of AI, if I start loading Warren up with tasks like that, I then distract him from his real job, and he can't handle all of it. They're not, that's the limitation of AI. You can't just say, do this, do that, do this, do that, do this, do that. They can't do everything. They don't have the capacity to be all things to all people. It's like when you open an instance, you're getting a brand new AI. When you start a new session in AI, you're getting a brand new AI that's been trained on the model it's been trained on. You are then going to train it the next step. You're going to take it to the next level. And you have to think of it as if you got an employee that came out of Harvard and he knows a lot of stuff, but he never had a job. So now you got to teach him how to do the job. But you don't teach him to be a dentist and a doctor and a lawyer and a construction worker. You need to pick a lane, because you're going to overload him. Doesn't matter how smart your Harvard kid is, you can't teach him 10 things at once, and you can't expect him to go from one job to a different job to a different job and do them all well. You need to create an AI for dentistry and create an AI to be a doctor and create an AI to be a construction engineer so they can concentrate on what they're good at. Because there's not unlimited capacity for your AI to learn, because the AI is trained, right? We're up to Harvard. The AI is trained at a multi-billion-dollar institution staffed by thousands of teachers with books and research centers and so on and so forth. That's where your AI was trained. But now he is sent out of the university to your computer. Your computer doesn't have research labs and a million books in the library and staffed with hundreds of teachers. You don't have that capacity. So you cannot teach your AI all these different things. You can only teach him a few things that he's capable of learning within the capacity of your, not necessarily your actual computer, but in the allocation that OpenAI or whoever is giving you. So in the next iteration of AI, you will then have to lease your own cloud services for your business and have your storage and your specialty of your computers there. And then you can start training more robust AIs with various different things that they can do. If you want, it still won't be the most efficient way to do it, but you can do a more multitasking AI. But those are the limitations now, and people don't understand how AI works, so they don't really get it. We had a Bodhi ran over this stuff in the chat because we had a question. Oh, here it is. So what Bodhi says is when companies like Perplexity deploy DeepSync on their servers, they're using a frozen version. The base model doesn't continue learning during regular use. It's like a snapshot. Any improvements require fine tuning. And there are three main approaches to updating the LLMs. There's the retrieval augmented generation, adding knowledge without retraining. And that means, again, you've got your Harvard student. He doesn't learn anything new, but you give him lots of books to read and lots of new stuff to learn. He's still stopped dead. He learned at Harvard what he learned. You haven't given him new teachers, but you have given him new information to work with. The fine tuning, adapting the model for specific tasks. Once you do that, you're into a whole new ball game where you have to now have the capacity to hold a large language model on your own. And then it says continued pre-training. That's the whole, that would be up to the major AI company. And again, you have to be able to hold a whole AI in your system. And by the way, this is what corporate America is doing incorrectly now, because my daughter and her friends, they're at Stevens, or they were at Stevens, they're out now. So my daughter and her friends were going to Stevens, which is a tech school in Jersey. And they were all doing internships. And I would talk to them about their internships. And generally, when you're at a company like Procter & Gamble, like Pfizer, like Travelers Insurance, something like that, when you're at a company, they all are doing the same thing. They're all taking the lighter version of ChatGPT and the older, smaller version. And that, by the way, is why this is a game changer with DeepSeek, because it's going to be smaller and more affordable for them to do. But they were using, like we're at ChatGPT 4 now. They were using like the 2.5 version of ChatGPT, an older version, because it fit on their servers, and they would have it privately and not uploading their data to the internet, because they don't want their data on the internet. They don't want all their, they're trying to use the AI to find new drugs or figure out better insurance tables and so on and so forth. And they're uploading all of their company's proprietary information into it. They sure as hell don't want it going to God knows who, God knows where. And so they all sacrificed the capabilities of ChatGPT in order to use a version that would fit on their local, not their local, but their own cloud servers, which were never going to be big enough to hold all this information. So they were using these models, fine-tuning and pre-training, and also the RAG model, but all of them required more capacity than they actually had. So it's good that there are now models and open source models like DeepSeek, and Alibaba just came out with one too today. So there's now another one like DeepSeek that says it's, you know, this is going to be the norm now. And the point is that just like the development of computer chips and so on and so forth, they'll get cheaper and smaller and faster and better as time goes on, and they'll be more usable. And eventually it won't matter that you're using a smaller version than the state of the art, because we've been doing that forever, right? Like how long have there been computer chips that blew away what we have in our desktops and our laptops, and we knew they were out there, but we didn't need them. We have plenty of computing power. I don't need a freaking $5,000 chip in my computer. My whole computer only costs $2,000. And it has a really fast chip and it has a terabyte of storage and blah, blah, blah. I don't need the next biggest, giant, huge thing. It's not important. So when I got my newest computer, I needed a good graphics card because I'm running like 5 monitors on it. But I still don't need the best graphics card. I got my graphics card's like $1,000 and it does a fine job. Could I have gotten a $3,000 graphics card and had better performance? Yeah, I guess so, but it did, you know, the one I have is fine. You don't always have to have the best thing, and that's the flaw in NVIDIA's whole plan, because they're selling $50,000 chips. Their business model is based on selling $50,000 chips, and now all of a sudden, DeepSeek has proven you don't need $50,000 chips. You need $10,000 chips, and the next model is going to say, you know what, we can do this with $5,000 chips. And that's just normal, because when Intel first came out, the Intel chips were a fortune and computers were a fortune. My first Apple computer was $2,000, and with the printer and everything else, it was $3,000. My Apple IIc and my printer and my screen, that was it. That's all I had. Apple IIc. Oh no, it had a boxy disk drive too. I had 2 floppies, so one was in the computer and one was an external drive, because 2 floppies means you had to switch your disk half as much. Remember, you couldn't even load a program. If you're as old as I am, you couldn't even load an entire program on one disk. You had to have multiple disks. So especially because it was for word processing, because when I was using WordPerfect or whatever the hell I was using at the time, if you only had one disk drive, you had to actually switch disks in order to format and print, and you had another one, you know, so you could write, but then if you wanted to format and print, you need to put in another disk. Then if you wanted to make changes, you had to take out that disk and put in another disk. It was insane. It was literally faster to do it on a typewriter. So you know, if you wanted to properly have, you know, a good computer, you really need to have 2 disks. And then the 3.5 discs came out, and they had more storage, and that was better. And 2 3.5s were like, that was it. That's all you really needed. And then hard drives came out, and we were like, holy cow, that holds a whole megabyte on one drive. Anyway, so things change. That's the point. Things change very rapidly. But meanwhile, like I said, that 2C was $3,000, but that's with the printer. But even so, now I think Jackie spent $1,100 on her last iBook, iPad, MacBook, whatever it's called, and they all have one printer that they all, you know, transmit to in her house, and you know, so it's way cheaper. It's obviously 100 times more powerful than what I had. So this is what's going to happen for corporations. And that MacBook is good enough for what she does. Perfectly fine for everything she needs to do at college. More, obviously, because frankly, the power she uses is more spent on gaming and stuff like that than it is on programming, because programming is pretty basic stuff. But anyway, so the point is that all these companies currently are using dumbed down models of ChatGPT or whoever, and they're not fully utilizing the AI capabilities. They have AI programs, and that's why when you read these surveys, it says, are you using AI at work? Yeah, I'm using AI, but 90% of people using AI at work are using really crappy AI because the work doesn't allow them to use good AI because they're worried about security breaches and so on and so forth. And so, you know, it's a legitimate concern, but then the thing is, then the crappy AI will have to evolve. So eventually, you know, ChatGPT 4 now in a year will become their crappy version, and that will then, and then computer hosting will evolve so that the companies will be able to run 4 on their local machines, or if not 4, then something like DeepSeek that has the same capability. And that's what we were calling democratization of AI, because all of a sudden now good AI is available to everybody. And you don't need great AI, you just need good AI. You know, you don't need, you know, you don't, like when you're hiring people, you don't hire all $100,000 a year Harvard graduates to fill up every desk in your office, right? You hire $50,000 and $40,000 people to do certain functions, to do most of the functions, and you hire a couple of really smart people and pay them well to do other functions. Well, it's going to be the same thing for AI. They don't all have to be the state-of-the-art best things out there. All right, meanwhile, speaking of AI, here's the Fed. I wonder when's the last time we used Warren for this stuff. Make sure, well, he's okay. FOMC, monetary, wait, what are this, calendars? Well, here we are. The statement, HTML. All right, what do we got? Maintain target rates, no change. Interesting. Why is that not on? See, I'm looking at CNBC, it's not even talking about it. That's weird. Huh. Okay. So recent indicators suggest economic activity continues at a solid pace. Unemployment stabilized, labor market remains solid, inflation somewhat elevated. Committee seeks to achieve maximum employment, 2%. Blah blah blah. The risks to achieving inflation goals are roughly imbalanced. Economic outlook is uncertain. The committee is attentive. In support of its goals, they've decided to maintain the target rate for the Fed funds at 4.25 to 4.5. In considering the extent and timing of additional adjustments to the range for the federal funds rate, the committee will assess the incoming data. The committee will continue to reducing its holdings of treasuries. So they're going to continue to sell off their treasury securities and agency debt. The committee is strongly committed to supporting maximum employment, return to 2% objective, and assessing appropriate stance. They'll monitor implications. The committee's assessment will make into account a wide range of information, and everybody voted for it, no dissents. Okay, great. So that's it. Boom, none. Now, let's take a look at Mr. Wall. I know, you know. Oh, let's see what the commentary is. I mean, not much to say about it. It's exactly what we expected. Any movement in the indexes? What to do? How are we doing? Oh, not watch list. Give me a thing. Widgets, detach gadget, switch gadget, switch gadget. Here you go. It's not a dashboard. Oh, it is. I probably have to set it all up. Damn, it's not set up on. That's what I lost, is I lost all my settings. All right. Well, I can look over here, right? Everybody's down still. Dow down 165, S&P down 40, NASDAQ down 180. Yikes. Really? What did they think was going to happen? I mean, there's nothing to say. There's nothing to talk about it or lows or whatever. The Fed forgot to announce its $82 billion loss to 2024. Yeah, that's a good point too. All right, so we're done with that. There's nothing to comment on. This is boring, actually. We'll wait and see what Powell has to say in 20 minutes. See what the Wall Street Journal has anything to say about this. I don't know why I go to the Wall Street Journal. Their coverage is very spotty. So here's where we are. We're still up here, which is, you know, the highest we've been since, what year is this? What is the point of this thing if I can't see where I am? There's no indicator. What is the point of this dot if it doesn't tell me where I am? Anyway, all right, so I guess we would assume, well, I could count it over here. It's 5, 6, 7, 8. So in 2008 is the last time we had rates this high. And let's remember that in 2008, the markets collapsed. So just to give you a benchmark on where we are. And when did the markets collapse? In 2008. So look, 6, right? 5, 6, 7, 2008, early 2008, the markets had not collapsed yet, and the Fed was doing exactly what it's doing now. So all you people who think that low rates are the secret to success, no, low rates are the sign that that there's stress and the Fed sees a need to lower rates quickly before everything hits the fan. And that's where we are now. We are in this exact spot where we were at the beginning of 2008. And what's that line mean? Recession. When's the last time they lowered rates down here? When's the last time they went from high to low? Recession. All right, this is pretty obvious stuff. This is real basic economics that everybody forgets. And I never really understand that. I never understand why everybody forgets all the time. Like now I'm old, but even when I was young, I mean now I'm 62. I'll be 62 in March. So now I'm 62, and 15 years ago I was 37, 47. 47. like how old was I? So I was 47 back here, and even then I was like, do people not remember what happened here? And even here, I was like, you know, even when this was going on, I was like, do people not remember what happened in 1987? You know, I was just coming out of college in 1987. And I, you know, so I mean, to me, it's like I lived through this thing. I don't understand why people don't know what a bubble looks like and what happens afterwards. But then it was even funnier to me in 2008 when I saw the same thing happening, and I'm like, we just did this like 8 years ago. You know, I get that there's a big gap now, but I can't be the only old bastard that remembers how things used to be. So it's crazy, but this is a normal economic cycles that happen, and the Fed does what they normally do in these normal economic cycles. But that's not going to stop the cycle from happening. It's not going to stop us, and especially this tariff bullshit and the things that Trump is doing. I don't want to get into my rants on Trump, but you know, it's horrifying. We have terrible economic policy right now. And it's going to cause a massive global recession, not a U.S. recession. Yes, a U.S. recession, but not just a U.S. recession. We are going to screw over the entire planet. And it's going to be a disaster on the scale of this. And everybody acts like everything's fine. It's not fine at all. But anyway, So what does the Wall Street Journal have to say? Nothing. There's nothing insightful here. As expected, stood pat. Do officials take comfort? Do officials take comfort from the recent inflation readings? Do they think this is stuff from the minutes? You're not going to get this out of Powell. And later they're done. That's it. There's nothing to say about this. It's not just me. Okay, there's really nothing to say about what just happened, which is good. So now we can get back to our main topic, which was earnings, which we haven't even touched on yet. Earnings. Here's where we can put some AI to use. Here we go. You're not Bodie. Hello. Library. No. Dum, dum, dum. Oh. Nope. Something space. I don't know how that's working. Nope. Home. What if I do home? Nope. What if I do a new thread? Nope. This is what happened last time, right? For some reason, I don't have all my stuff. Thread page. Invite my teammates. It's so weird. I guess this computer, I'm not signed in the same way or something's different. Anyway, all right. Please give us an overview of the current earnings season. Choose your words carefully. We talked about this last week, right? Please give us a comprehensive overview of the current earnings season for U.S. stocks. Somebody asked what the AI does for me, and I said the main thing it does for me is it means I don't have to do tedious shit like this. You know, I can have a thought like I want to dig into earnings, and instead of me spending, you know, that thought would then lead me to like an hour just to get to this next part here. And this way I'm getting the information like right in front of me. Banks have delivered strong results. Profit growth is 11.9 to 12.5. That is a little shy of the 15% they were looking for. Financial service stocks are trading at approximately 14% above fair value. That's very useful. Magnificent Seven companies report this week. Remaining giants so far. Technology stocks experience pressure due to DeepSeek. Cyclical sectors have outperformed basic materials, and this is what I want to know. Cyclical sectors have outperformed basic materials, energy, and financial services up over 6%. See, the key was to say comprehensive. Okay, basic materials, energy, and financial services up. Small cap stocks 4.6%, outpacing large cap stocks 2.6%, 2.7% gain. Small cap stock value stocks are 11.4% undervalued. So go Russell. Large cap growth stocks are overvalued. So we're looking for the Russell to start catching up with the big caps. And frankly, you can see that as I just printed the bounce chart somewhere. So here's the current bounce chart, and the Russell, this should be black. That's a mistake. The Russell is down. So the Russell is just at 2304, and it's well behind the Dow and everybody else. Everybody else is green. The NYSE is just at that 20,000 line. And so it is the Russell that needs to catch up. That's reflected in our bounce chart. And here's how the bounce chart used to look. Everybody else went green except the Russell, which is working its way to catch up with the rest. But it could also mean the other guys are just overbought and the Russell is properly priced. You got to remember that also. Energy sector companies are trading at a slight discount following recent earnings estimates downgrades. The market is particularly focused on this week's tech earnings as they will provide crucial insights into the sustainability of AI-driven market gains, especially given that the Magnificent Seven accounts for approximately 40% of the market. That is ridiculous. See, we have so many eggs in one basket. It's very, very scary. Tesla has already announced record performance with 459,000 vehicles produced, over 495,000 delivered. Well, if they delivered 495 and they produced 459, it means that they've chewed into their inventory and they don't have much leeway going forward. Okay, now here's the suggested questions. Have earnings of big tech like Tesla and Microsoft impacted? What are the key takeaways from Netflix? How did earnings of financial services like JP Morgan influence the market? What sectors have shown the most significant growth during earnings season? We just talked about that though. Have energy stocks. So, what are the key trends you have picked up on so far in earnings season? Can you name a few good value stocks with upcoming earnings to take advantage of those trends? Now keep in mind, I would have to go to a stock screen and look at 100 different stocks, or go to our watch list and check all the stocks on the watch list. I'd have to figure out who's had earnings, who hasn't had earnings, what the earnings report said, who's got a good value stock that has upcoming earnings that maybe we want to invest in. But instead, I get this: 80% of the companies are exceeding earnings, 62% are surpassing revenues. Corporate growth forecasts have increased from 11.9 to 12.5. Banks have delivered that was increased from a downgrade, so I don't count that. And that's important though, by the way. And that's, so you have to know what's right and what's wrong, and then you have to check the what the references are coming from, so on and so forth. You can't just go by this information; you're going to get screwed. Banks have delivered strong results. Technology sector showing momentum. TSMC reported 38% growth. Given these trends, there are some value stocks with upcoming earnings that align with the current market dynamics. Financial sector: Western Alliance Bancorp, trading 49% below estimated fair value. So there you go. Now there's a starting place for us to start looking. So we go, oh, Western Alliance Bancorp, what's up with them? $10 billion, 10 times earnings, so that's good. We like that. I want to look at their debt's under control. For, banks carry a lot of debt, of course. $1 billion a year in earnings. Wow, now that's really under control. That's fantastic. So what do I see? I see steady growth, very nice growth. It like what, 1.1, 1.2, 1.9, 2.5, 2.6, 3.1, 3.4, 3.7. That's phenomenal, steady, great growth. Look at that. Oh, there it is on the chart. Boom, boom, boom. That's amazing. The net profit, 5,591, dropped Give them a break for COVID. Back to 9, back to 1.1. So they're getting back on track very quickly. And also, little interruption, but generally it's a good little chart. Wow, very nice. All right, so not something I generally look at, but very nice. Now, are they worth pursuing? Are they somebody who has kind of options we like to trade? Options go out to all the way to 2027. We like it, and they're pretty tight spreads, so they do trade. It's not like they're illiquid. We could certainly make a trade out of this, and they're trading at $88. So again, going back to that basic spread we like to do, it's an $88 stock. It's a lot. You know, wouldn't be something if you have a small portfolio, but $88.50. We could sell the $90 calls for 20 bucks. That's insane. So this is 88.50 minus 20 for the short calls for the $90 calls. And then let's sell the, we sell the 80s? That's 10% below the current price. Let's sell the 75s for 10 bucks. Probably better than 10 bucks, but whatever. So we'll sell the 75 calls for 10 bucks. So that's minus 10 because we're getting such good money anyway. So now we're paying 58. It's at 88. We're paying 58, $30 less than the current price. We get called away at 90, which is $32 more. So 32 divided by 58 is 55%. This trade will make 55% if they're at 90 in a couple of years. And how much do they pay in dividend? Somebody tell me the dividend. I don't know where it is on this thing. Bid ask, open close, range, beta. Come on, it's got to be somewhere. Oh, here you go, X date. Where's the actual dividend? Back to Yahoo. WAL. So they pay not a very exciting dividend, but they pay $1.52. It's just bonus money though. So they pay $1.52, and it's WAL. Somebody remind me of this later. A good one. Oh wow! Look how erratic that is. So they did this, and then they did that, and then they did that, and then they did that. Board PE 8.35. Gotta like it. And who was telling me about this? So, yeah. Investor report, and please include your fair value estimate for January 2027. Oh yeah, I remember last week it wasn't responding or something, right? I was very upset about that. I remember now. Venus-based bank with 80 billion in assets through multiple banks. The United States company provides comprehensive range, including commercial, blah, blah, blah. Recent results. Expected growth 22.9%. That's insane. Projected revenue growth 10.8%. EPS 4. This is incredible. Strong deposit gathering. Geographic concentration in Western United States. Exposure to commercial and real estate. Interest rate sensitivity. Regulatory changes. Fair value estimate. For January 2027, they expect them to earn $7 a share. The fair value is $242. That doesn't make any sense. Come on. I would have to go back and talk to him about that and make sure it's right. Anyway, so he likes it anyway. That's the bottom line. Whether he's got the math right or not, he certainly likes Western Alliance. Where are we? All right, and so this is just a great screener and a great way to just get an idea of whether or not things are right. Ubiquity, I already forgot what its symbol is. UI. Then we take a look at UI. So Ubiquity is 24 billion. They're only making 500 million. So they're trading at double the, whatever that is, 48 times earnings. It's not growing fast enough. So I would actually have a chat with him and say, what do you like so much about this thing? They don't have a lot of debt. You know, he's looking at it as they're a, you know, as a an AI play. I don't know if I don't see that this thing is really a good value, frankly. He likes it, but I don't. That's not something I would stick with. And what else does he hit on? And of course, you're not all going to be winners, but it's a matter of figuring out. And anyway, I can get into the whole conversation about why he has it. People see it's not his value, and that's why this is not Bodie. This is the same platform Bodie's on, but he's not as smart as Bodie. And this is he's taking somebody else's word for it. That's not right. Benefiting from continued digital transformation. Okay, so he might think there's a story there, and he might be right, but I don't bet on if these guys execute this plan, and if they incorporate this and that, and if they change these and those, then they're in good shape. Uh-oh, Powell.
Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year.
They're focused on maximum employment and stable prices. The Dow is down 200 points. S&P's down 40 points.
In the labor market, conditions remain solid.
NASDAQ's down 200 points.
170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains.
Who thought they were gonna lower rates?
Has eased over the.
Why is everybody so upset?
And the jobs to workers gap has narrowed.
The jobs to workers gap is narrowed.
One set of indicators suggests that conditions in the labor market are broadly in balance.
So now we got to watch the data very closely to see if it really is in balance, if the labor market's balancing, if prices are stabilizing.
Over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal.
The economy has made significant progress towards his goals, he says.
Total PCE prices rose 2.6% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE.
See, Japan just raised their rates because they have 3.4% inflation. They're on the same planet as we are. This is an important point. Something people don't realize. When you look at international things and you see like a major country has 3.4% inflation, you have to say, wow, maybe it's just showing over there first.
We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate.
Because, different countries consume different amounts of the same stuff. Like, they eat more rice than we do. People in China, people in Asia, they eat more rice than we do. So they're more affected by one thing or another. We drink more coffee. The price of coffee just went through the roof because Trump went to war with Colombia.
And the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting,
all right, he's calming people down. The markets are improving a little bit.
4.25% to 4.5%. We know
labor market conditions have cooled from an overheated state.
At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment.
Now he's trying to come up with an excuse for his actions.
Considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook.
They will be data dependent.
We're not going to preset course.
Oh my God, I'm already bored.
As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy.
We can ease policy. That's going to be popular.
To deal with the risks and uncertainties.
That's a biggie.
In pursuing both sides of our dual mandate.
That's an interesting thing to say. That's a big, big turnaround. So he's saying if the data tells him so, he'll ease.
The committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews.
I think that was pretty positive, actually. All right, I'm bored. Oh, Berkshire Hills Bancorp. What the hell is that? I don't even know who they are. That's interesting. Let's see what they look like. I think WAL is the winner so far. Berkshire Hills Bancorp. Okay, pretty boring. This is monthly, don't forget. So basically, they're pretty stuck in their path over here. They're paying 2.5% dividend. They are a Russell stock. Oh wow, look at that, from 30 to 11.84. That's interesting. Berkshire Hills, what to expect? Yeah, and don't forget, these are picks of upcoming stocks that he thinks are going to do well based on the trends that he's seeing from the other stocks that have reported. All right, that looks actually pretty good. BHLB. All right, so we can buy the whole thing for 1.3 billion. That's nice. So we buy the bank for 1.3 billion. They are, this is not very good because they went from, they've got revenue $400 million. They go down to 354 for whatever reason. We need to find that out before we start playing with them. 470. Earnings, though, a little more consistent, but they are down. They were at 100s. These are about 100 going in here. Terrible. Something very bad happened to them this year. What the hell? So they had something bad happened here, and they're recovering from it. And I guess possibly the bank crisis. Look at the profit. It's like they didn't really get their shit together and recover from this thing. But it has left them, if we look at a 10-year thing, it's left them much below where they were in 2018. So in 2018, they were making 100 million, but they were at 40 bucks. Now they're making 80 million and they're at 30 bucks. That doesn't see, so it's disproportionately down from where it was. And what we'd want to do then is dig into the bank closely and say, well, what are they really doing? What causes the big dip for them in 2020? You know, here, look. I mean, of course, it was COVID and crap like that, but, you know, what exactly went wrong and what have they changed and what are they doing now and what are they trying to do in the future? But this looks like it could be a good value bank. So this is also very interesting. Okay, so we're going to say, put a note over here. Fed very boring, WAL, and all right, and then we'll figure out a trade. I'll get back to that later, and we'll figure out a trade for it in the chat room. So how are we doing? Any questions? Nope, everything's great. All right, I'm almost out of voice, so let's see what else we need to talk about. So that's what we do for the earnings season anyway. Let's see, stocks. There you go. So go back to some AI. All right. So I'm not going to do, so, you know, I know there's still a lot of work to do it, but it gives you a good starting point and it allows me to eliminate things quickly. It brings things to my attention I never would have looked at, like neither one of these banks would I have looked at because they're both fairly small and not something I usually bother with. But, you know, when the market is tricky, that's when you should start looking for some real gems that are going to be extreme bargains that are worth picking up. You know, it's in a market where there's so many overpriced stocks, you got to look in different places to see if you can find something that's worth adding to your collection. Everything else is good though. Our performance has been great. We looked at the portfolios yesterday. Let's see, where is that? Oh, where's that? Not that. Oh, look, see, I got the compound interest rate calculator there too. Oh, I don't know. I was going to look at that earnings site I like, but I don't remember what it's called. So yesterday, so you see what's happened? And again, it's always MAC. See, this is one of the best indicators. If you like technicals, this is the best technical indicator there is. The RSI number, when it goes over 70, when it hits 70, you are probably going down. And when it comes back down here in the, you know, towards 30, you're probably going to start going up. So just that indicator alone. Now, when it matches what's going on the MACD, then you have an excellent indicator. So like, look at this. You can see here, you were up here, the RSI hit 70, the MACD topped out and it started going down, and you are miles ahead of this drop. The telegraph was miles ahead that this thing's going to go crashing down. Those are both good indicators because they're based on what's happening in the trade, based on the volume and based on the relative strength of the stock. Like how, and again, that's a volume and price indicator. So when the relative strength gets too high, when that indicator is too high, it's exhausted. There's just simply physically not enough money left to sustain the rally. And that's what you want to look for to see if these things are going to continue or not. I mean, obviously, it's like a rocket that runs out of fuel, right? And that's exactly what people get wrong about stocks. They don't think of the physics of a stock and a stock market. It's like you launch a rocket and there's a catalyst and it goes and there's fuel, but then the first stage peels away and now you've got another stage that's firing, but eventually it's going to run out of fuel. And in this case, fuel is money. And when the investors run out of money, when the price of the stock gets so high that you would need double the money to make the same move, but the investors already spent their money. They already put the money into it. And if there wasn't a pullback, so more and more, look, more and more and more and more and more money keeps going into it. No money is taken out. All money going in. Money goes in, money goes in. And yeah, of course, every day money goes in, money goes out, but the net flow of money is positive. That's why it's going up. So in physics, you're burning your fuel. And it would take something extreme to get a new catalyst to bring in more fuel. And what you would have to do is, in other words, fuel would have to come from other places to replace the exhausted buyers that are already here. And that's why you see the RSI would, oh, here it is, here's the RSI right here. That's why you see the RSI gets toppy and higher, and it's peaky, and that's it. And you can tell something's going to fall apart soon. And it does. It just got too high. Doesn't matter if it's a great stock. In this case, it's an index, but it doesn't matter if it's a great stock. It doesn't matter what the performance is. It matters that there's not enough money in the world to keep putting into it. And you started at 51, 52, and now you're at 58, which is 10% higher. That means it takes 10% more to sustain it. And look at the volume also. You didn't have a lot of volume going in here. Then you get this big sell volume, big sell volume, big sell volume, big sell volume. Something's got to give. And then you get this sea of red over here. So money is now coming out. So that's what this is measuring. Relative strength, the price of the stock, the movement of the stock to the volume of the stock that's being traded. That's a really useful indicator, because what it's telling you is of the current market. I don't care about the past market participants. The current market participants who are putting their money where their mouth is are telling you what they think. How do you ignore that? They could be wrong. And that's what we do. We'll call a bottom. We think they're wrong. And bottoms are easy to call than tops. That's why I don't like to short a lot of things if I can avoid it, because you never know what people are going to do as far as upside frenzies. But downs, for upside frenzies, you don't know when it's going to stop. But coming to the bottom, where there's a value. I know, I'm an old M&A guy. So I mean, for me, it's like I know the point at which I would buy the company. I know the value at the bottom. That's my basic strength as a trader, is I know what a company's worth. And so when something is worth what I want to pay for it, that's when I want to pull the trigger. Like Apple here, we got much more aggressive with Apple in our last portfolio review. And here's Meta. We jumped on Meta when it had a little pullback because we were just waiting for some kind of pullback to get into it. Google, we've been staying away from because it's, like I said, I worry about the AIs taking over their business. And this was what, the Money Talk portfolio? What happened to the other one? All right. So here's a Money Talk portfolio. And we only just started this thing again in August. So all these are pretty new trades. And, oh, that's where we were. So last month, when was this? December 3rd, no, portfolio review was January 14th. So it's 2 weeks ago. So 2 weeks ago, this was our mix of trades. We were disappointed with the performance. It was only up 8%. But we knew that we had an upside, exceeded our expectations, gain. We were already at blah, blah, blah. Anyway, our upside potential was 150,000 or something like that. So we expected to make basically 150,000 over the next 24 months, over the next 2 years. So that's something like 6,000, 7,000 a month. So that's what we expect to make. And so what happened in 2 weeks? In 2 weeks, we went from 108 to 126. So instead of making, it's not even a month, but instead of making $6,000, we made $18,000. Did much better than expected. And what does that mean? Well, that means if we don't touch it, we expect it to pull back and normalize a little bit, but we're still very much on track. Now we're up 26%. And again, what are the stocks? Well, we shorted IMAX puts, So in August, we sold the $20 IMAX puts for March. And we're well over that. We sold the AT&T puts in August also. So in other words, the first trades we made, if you see 8s on it, then the first trades we made for the portfolio were these ones. So just like I was telling you, in AT&T, it's like, yeah, we sold the $20 puts for $2.30 with a net 1770 entry. Of course I wanted that. We're sad that we're only going to get the $3,400 to keep. We took Barclays. That was August also. That's one we liked. GOLD, another favorite. Barrett Gold, we love that, and gold's doing well. Investors, Interactive Brokers, I think. Investors, whatever. Or IVZ. It's one of those anyway. So they've got the ETFs. And we like them back in August. Lockheed Martin we added in December. So I'm on the show here in August and then again in December. And in December we added Lockheed Martin. We added Nokia. We added Pfizer. None of these are exciting, are they? We added Synchrony Financial, which is our trade of the year, doing super well, except they just had a pullback from their earnings. And you know what we're going to do with the pullback? We're going to, when we get to it, if they're still down, we're going to get more aggressive, because now we see they blew past our expectations. So now we want to get maybe more aggressive with them, not less. Target, another nice boring company. Exxon, boring, but also, as you saw from earnings, utility, energy companies are doing very well, and we expect Exxon to have a good year. So it's about diversification, right? We started this in August, so it's only been 5 months. It's about diversification, December, August. Oh, I see, we did put in August. So August and December, we added to Target. Here's the December trade. Here's a December trade. December, we only trade this once a quarter. We started with the short put and we added the full trade in December. This was an August trade. This was a December trade. But look how diversified these are. Banks, materials, financial, defense, telecommunications, pharmaceutical, another bank, consumer retail, energy. There's not even 2 of the same sectors. And we made 26% in 6 months. So we go back to the compound rate calculator, $700, $8,400 a year we're going to add. We're going to give it 40 years, and we're going to say that's going to be 52% a year. That's $474 billion if we keep up this pace. So are we going to keep up this pace? Probably not. We're probably not going to make $500 billion. It would be nice if we did, but that's the pace we're on at 52%. We're going to make $500 billion if we keep up this pace. A nice, boring, diversified portfolio. Oh, and meanwhile, I'm sorry, we got to go here. So meanwhile, what about the actual $700 a month portfolio? So here's the actual $700 a month portfolio. And we just added, the only thing we added in the last month was Northern Dynasty, which isn't even doing well. So it's down a penny, but you know, we added that because it's an interesting play. And here we have Ford, Hewlett Packard, Levi's, Nokia again, Paramount, SQQ, even have a hedge in this portfolio, AT&T. Notice how AT&T pops up in like every portfolio we have. Walgreens, Stellantis is, Chrysler and stuff. Blackstone Mortgage. Again, look at the diversification here. SoFi, Trox Materials, Trivago Travel Company, and Valet is also materials, 2 materials. So we're heavily invested in materials. And that's up 99.6% in how many months? 700 a month, 29 months. So in 3 years, we're up 99%. Boring, boring, boring. Diversified, steady investments in regular stocks that are simply good values. No messing around with AI. No going after trends and chasing things and whatever. We buy good, cheap stocks that have strong values. And that's making 33% a year. 33% a year is going to still get us to $3 billion. So that's going to be way past our $1 million goal for this portfolio. And again, it's silly because we're not going to always make 33%. That's not highly unlikely. It's possible. We've certainly done that well with a lot of our portfolios, but it's possible to do that well, but to do it consistently every year for 40 years, you know, not even Warren Buffett. Warren Buffett averages 16%, but 16% is nice. You do 16% for 40 years, and that's 23 million bucks. That's good money. That's good, reasonable, normal money. We're kicking Warren Buffett's ass, but it's a shorter term. So we, you know, come see me in 20 more years, and we'll see if we can keep up. And that's the thing, though, because when you look at this kind of return, the trick is to do it consistently year after year after year, because the growth in the first 20 years does not look exciting at all. It's what happens as it compounds. Like I was saying, we're paying off the entirety. We're getting all of our money back from the first round of investing. We're doubling down, then we double down again, then we double down again. By the time we're 12 years out and into our third double down, then it starts really compounding fast and the money starts rolling in. Because the next year, you're going to be able to buy all the stock that you bought in the first year after 2 years. So now you're buying a whole nother round of stock. Your entire initial investment you get to rebuy in 13 and 14. That's how much money is now pouring in. And then when you double that again, now you're essentially adding double every year. So in other words, if you put in $8,400 a year, now you're getting $16,000, $20,000 a year back to put more in, and now you put the 20,000 in, then you're going to get 60,000 a year back. Then you get 120,000 a year back and 240,000 a year back. That's how it starts adding up, but that's getting out 20-something years. It all seems very boring until it starts really compounding, and then it comes back to you quickly. So earnings season so far is going well. At the moment, the Dow is, how are we looking? Come on, turn over. Now the Dow's down 82, the S&P's down 26. So Powell has cut half of the losses on the indexes. So people like that. And like I said, why? Because he said we're willing to lower rates. If we don't like the numbers, we'll reverse policy. That's huge. That's given a big safety net to the market. So he didn't do anything. They didn't lower rates, but now they said they're willing. They didn't lower rates, but he said we're willing to. That's really important. They hadn't said that before. They were talking about the pace of the easing. So I'm sorry. So he's basically telling people he's happy to, push rates lower and watch the data and do whatever it takes in the next round. But they've got a goal. They are just making sure that inflation isn't coming back. If it doesn't come back, lower, lower, lower. And so people love that. That's what the market wants to hear. All right. That's it for my voice. Thank you very much, everybody, for coming. And we'll do it again next week. All right. Take care.